In this presentation, we will compare the business and personal QuickBooks files and reports after entering data for the second month of operations, the month of February. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are on the home page of the personal account. So we're currently in the personal account. We're going to be comparing reports to our business account. Remember, what we have here are two separate QuickBooks files, one QuickBooks file for our business, one QuickBooks file for the personal. And now we'll take a look at how we can think about those financial statements that would then be generated from these separate QuickBooks files. To do that, we're going to go up top and generate our financial statements once again by going to the Reports drop-down. Company and Financial, we'll take a look at the Balance Sheet Standard. Balance Sheet Standard, changing the dates. And we're going to go from 01/01/20 to 02/29/20. So that's January through February 2020, the year we are working on. Okay. We're going to also open up our profit and loss by going to Reports up top, Company and Financial, Profit and Loss Standard. These being our standard two reports, we want to be able to go to them fairly quickly. We're going to say the dates are going to be 01/01/20 to 02/29/20. That's January through February 2020. We're now going to compare that to our information for the business, which we entered into a separate QuickBooks file. Now, one of the problems, of course, with having two separate QuickBooks files is we cannot typically open them at the same time. So what we've done is we've printed the reports from, or saved them as a PDF file, from the business account, and now we can make some comparisons and think about them together as we can see them side by side. This, of course, would be easier to do if they had like two screens or if we printed them, but we're going to be jumping back and forth a bit, so bear with us. So here's going to be the balance sheet for the business. And the balance sheet for the business is pretty straightforward. And remember, what we're doing is, like in both cases, personal and business, entering data directly from the bank statement into QuickBooks. And therefore, the balance sheet isn't really where we're focusing other than making sure that the checking account has been reconciled. So, and, you know, the other side will be, of course, equity. But other balance sheet items aren't where we're really focusing right now. Things like loans and things like if we had a loan payment, we'd have to deal with that. But other types of things that could be balance sheet items. So just be aware of that. We'll discuss that a little bit more later. We're dealing with activity when we enter the bank statement, which is typically what we need for budgeting, what we need for tax preparation. So on the balance sheet side, however, we're going to get the cash in a separate checking account. That's the key to this method. If we have two different QuickBooks accounts, we want to make sure to have two separate checking accounts. This will typically be the recommendation for anybody starting a business to say, hey, you got to force yourself to separate your business stuff from the personal. The best way to do that is to keep separate records, separate checking accounts, separate QuickBooks accounts. And so that's the first thing we have. We're separating these two checking accounts here. This one on the business side being different than the personal side. And then the equity side over here is where we want to kind of focus. Most people don't really understand equity too well on the balance sheet, but just note that what it really means is this full equity number in terms of a sole proprietor is kind of like the net worth of the business in a way, or what's owed to the owner. So in other words, assets minus liabilities, we don't have any right here on the business. It gives us the equity, so they're the same at this time. And then the detail, QuickBooks is trying to break out the income statement, trying to tell us how net income is related, how the income statement is related in a way. So this is the income. This is the owner's equity. Net income will roll into owner's equity. Draws is what we took out of the business. So this is going to be money that we took out, we recorded as draws taken out. And then we created this other account called owner investments. And that's the money that we took out of our personal account, put into the business account. And so these two are really where we want to focus here, because these will show us kind of the interplay between the business and personal in a way that can get a little bit confusing. So this is the money that we took from the business account, from the personal account, and put into the business. This is money that we took out of the business and put to the personal account. We hope this transaction to be the norm in the future, meaning we hope the business will generate revenue. We will then take money out of the business and put it into the personal account. That's the norm. This is what typically happens when we start the business or when we expand the business, meaning we take money out of the personal account and we put it into the business. So let's take a look at the personal books now. And if we go to the balance sheet in the open windows, we're going to the balance sheet. We then have our checking account that is separate, of course. So we have the separate checking account. We've got our E-Trade that we've broken out, but this is just the activity that happened that we put in there. We haven't really looked at the financial statements for those investments, stocks and bonds. So we'd have to really look at that to shore things up, because we only have 2 months of activity that happened here. So that's may not be an accurate number. That might just be an investment. And then we've got the credit card and then the equity. So here's our equity accounts down here. Now I'm going to open one other account, which is going to be a trial balance, in order to help us to analyze the difference between these two accounts that we were looking at on the business side. So let's go to the reports drop down, company and we'll go to accounting and taxes, that is, reports, accounting and taxes, trial balance. And we'll change the dates from 01/01/20 to 02/28/20. And this will give us like a chart of accounts without the sub accounts, but it has debits and credits, which can be confusing. We don't need to worry about them too much at this time. What we want to do is scroll down and we want to check out the account related to this one. Actually, I don't need to scroll down. Due from business. So you can see it's 0. That's why it wasn't on the balance sheet. But if you go here, you can look at the detail of it by double clicking on it. And you can see that the activity then here's a transfer that we had to the business checking account. And here's an expense that we made out of the personal account that should have gone to the business that we allocated over. So that gave us $2,370. And then we had this transaction where we, if we double click on it, we had a deposit of $2,500 and we put $2,300 to this account to bring it to 0, and the rest went to the business income. So in other words, if we go back to our balance sheet, the difference between these two numbers on the balance sheet for the business account, this 2500 minus the 2370 is 130. So that's going to be the income, if we go back to the personal, that we put to the income on our personal account from the business. So if we go back over here, what we're saying then is from the personal account, this is once again the business balance sheet. The personal account put $2,370 out of the personal account into the business, in essence. Then the business paid back $2,500. That $2,500 is paying back the $2,370 that was paid from the personal to the business, and the amount over and above that, the $130, is then cash that was paid out of this business account to the personal account over and above the initial investment from the personal account to the business. So there's a couple different ways we can account for that. On the personal side, then, we see that on the balance sheet, that due to from is gone. We took that off the books and brought it all the way down to 0. And then on the profit and loss, we are reporting on a cash basis the 130 from the business. So the 130 here is on a cash basis. That's what we actually took out of the business and put into the personal account. And so in this method, what we're doing here, what I've done here, is record this amounts that are taken from the business on the personal account on a cash basis. And if we go to the business account here, that's what we've actually taken out over and above our initial investment. If you look at the profit and loss, however, notice that the profit and loss is $3,556. So this is the net income recorded on the business side of things that has not yet been, possibly hasn't been distributed yet fully to the personal side of things. On the personal side of things, we got distributed from cash $2,500, and we had given to the business $2,370. The rest of it's still being held. Some of it's being held by the in the checking account. So that interplay between the two accounts is really one of the most confusing things between the investments from the checking account personal to the business and the draws from the business account to the personal. And this is only one way to kind of record it. Right here I'm recording income on the personal side on a cash basis. After the business has paid back the initial investment, then anything else I'm recording over here as basically income on a cash basis on the personal side as we draw it out. And so it's included then in net income. So the other way we could do this, if we go back to the balance sheet, is to record it not as income and record it on the balance sheet. So the two accounts always kind of flip and work each other out. Let's just take an example of that. So if we then took this transfer account and I said that we don't want the 130 here, but we're just going to make the whole thing the 2,500. That's the full amount, and save and close. Then we can go back to this transfer account and kind of match these two things out. If we go back up, it's on the books as an asset here, but that's okay. It's a negative asset. We can match that to what's on the books on the business side, which is the 2,500. It's the difference between the draws and the investment. 2,500 minus the 2,370 is the 130. And that's the other way we can kind of do this. And if we do it that way, then we're not recording the income on the income statement of the personal side as we get paid, but rather we're just tracking the difference on the balance sheet. And in that method, of course, if you go to the income statement, it still works because the income statement just won't include any of the business income. But the business income is being recorded on the business books. So we just have to say that this is the business income and add that to our personal business income. So those are the two methods we can use. The other method, the one that we had prior to this, was showing the income on the personal side from the business on a cash basis as the business was getting money from, as the personal account was getting money from the business. So hope that makes some sense. So I'm going to go back over here and change it back. So I'm going to go back to the due to from business, and we're going to go to that 2,500, and we're going to change this to 130 again, and change this back to 2,370. So we'll save and close. And now, once again, this goes back down to 0. And we don't see anything on the balance sheet because we've been paid back on the personal side. So the company doesn't owe us any money. Not only that, but we have the 130 paid to us on the personal side over and above what we paid the company. So that's the main thing to do on the comparison. The net income, we've got the 17,402 on the personal side. If we take a look at the net income on the business, we've got this is the January and February. We've got the 3,556. We can see we can run similar reports for the business and personal. The only difference being on the business side, the expense accounts typically will sound more like what we probably think of as QuickBooks expense accounts, because QuickBooks is typically used for the business. On the personal side, of course, we will be using whatever expense accounts we think will be helpful for us to budget, to track where we spend money, for whatever purposes we want to know where the money is going. For more accounting information and accounting courses, visit our website at accountinginstruction.info.